the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Hey everybody, and welcome back to Teaching Tax Flow, the podcast. On to episode 92 today. We are going to dive directly into car and truck deductions. That's right. We are going to explain what they are and what they aren't. But before that, let's take a brief moment, as always, and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell them TTF sent you.
All right, everybody, as you obviously read in the show description, because we know you read all those descriptions word for word and understand them, and obviously you see the title, we're going to talk about those car and truck deductions. So as again, you heard in the intro, we're going to talk a little bit about what they are and what they aren't. So why I say that's important, right? I'm sure there's a lot of people out there, and I can say this firsthand because I've heard it. And, I was probably one of them at one time too, thinking you can just deduct everything that relates to your vehicle. So we're talking mileage, fuel, oil change, car washes, window tint, window stickers, vanity license plates, everything. It's not really the case. So we brought on a good guest today. More importantly, let's recognize the fact that Chris Picuro is not here. So as everybody knows, I've known that guy for a long time. I can say whatever I want to about him on this one, and I don't even have to edit it in or edit it out because he's not here to defend himself. So anyways, back to the topic. So Shawn Flattery is actually joining us on this. I've known Shawn for a while. Great guy. We've done a little bit of travel, bumping into each other, but more importantly, he is an expert in this area. So without further ado, Shawn, how's it going, man? How are you today?
Good. Thanks for having me. Good to talk to you again, like always. So I guess we want to talk about vehicle depreciation or expensing on that. Is that what?
Yeah, let's look at this, right? So I mean, me being a gearhead, I'm thinking, I'm like, man, how can you deduct, put in a big block Chevy in a Miata or something? So we're gonna leave all my random ideas out of the mix, but I'd probably say that the best place to start with this, right? So talk about who can actually deduct any vehicle expenses. So it's not just anybody working a W-2, right? This is more your self-employed business owners, et cetera, right? So kind of walk us through who can take those deductions for one, and then really just how a vehicle is even reported at all when it comes tax time, right? So kind of walk us through what a vehicle means to a tax pro.
Wow. So we just really got into the exciting stuff here.
Oh yeah, we jumped right into it.
Yeah.
I'm excited about this.
Yeah. So if we're talking vehicles, now first off, you got to be a business owner of some sort, right? Unfortunately, Congress has removed anything that is for personal use of vehicles. There's one exception really out there. There might be one other that I'm not aware of, but it's for the military. They do have some exceptions. But if you're not military, you probably cannot deduct your vehicle at all. Just stops right there. If you do own a vehicle, now we're talking maybe. And the maybe kind of goes into how much you use it for your business and what it's used for. When you're looking at a vehicle, the key threshold is 50% or more. If you're using the vehicle for 50% or more, for business, then we can start talking about depreciating and taking actual costs. So you're talking about dropping an engine in there. It's possible. You can write off a new engine on a business vehicle. You can also write off, I don't know, I'm not such a gearhead, right? I just, if you want to visualize my office, I'm a true accountant, right? I'm sitting in my basement. I haven't seen the sun in days because that's just what we do. So when I think of business vehicles, I think of like a car freshener. Those little, looks like a little green tree. Yeah. If it's truly a business vehicle, 100%, yeah, you can probably write that off too. So it's pretty much, it just kind of depends on whether you're using the vehicle enough to justify actual, and that's where depreciation comes into play and other expenses like dropping the new engine in or my car freshener. Or if we're talking, hey, this vehicle is not used enough, so under 50% use, or just a cheap vehicle that you want to use standard mileage.
And with standard mileage, right? So now we're at what, 64, 67 cents per mile?
Oh, it pumped up. We're now at a grand total of 67 cents a mile in 2024.
And it was just if I remember right, it was not too long ago, right? It was like 58 or something. So I feel like recently it kind of jumped.
Like everything, prices have gone up, so Congress has slowly bumped up the cents per mile.
Hey, at least they did that, right? And then
Very generous.
And Shawn, this is actually, so I've heard this multiple times in conversations with, people that may have just been getting into business, or, not to go off the deep end on people that think deduction means free for something, like, oh, it's a business expense, it's free. Well, we know that's not the case. But say somebody's going out, they're like, all right, listen, I need a vehicle. We're going to assume that we'll just say it's 100% for business. Say it's a fleet vehicle or something. So there's no chance that it would not qualify for business use. So if they're going out, when we can get into lease and buy if we want to a little bit later on, but if somebody goes out and they purchase the vehicle, we'll call it $60,000, $50,000. They go out and they buy it. Say they don't even finance it. Say they pay cash for this thing. Great. It's an expense. The vehicle's registered with them. At that point, they've chosen to actually take the expense as the deduction. So taking mileage deductions beyond that, is that still the case? Can they still take mileage, or is it if and or? How does that situation?
Yeah, you can't do both. So this is kind of one or the other. In any given year, you either take standard or mileage. Now, it is possible to switch it, where if in your first year you use, I believe it's actual expensing, you can the following year switch over to standard mileage. But in my time filing taxes for 10 plus years is either it's all in depreciation, actual cost is a better way to go, or mileage. I don't know if they still, they don't sell them anymore, but if you go off and find yourself a Pinto or a Gremlin out there, those vehicles are probably pretty cheap, under 20,000. Maybe not, maybe they're a collector, I don't know. But under 20,000, you might be better off doing standard mileage, regardless of use. But if you're talking a 50, 60, and that's actually a cheap vehicle now, right? You're trying to buy a truck, that's going to be easily $100,000. There's no way that standard mileage is a way to go. Just in running that thing every year, you're going to want to do action.
And then either whichever route somebody goes, right? Obviously, maintenance cost, again, making the assumption that it's strictly for business, all the maintenance costs, fuel costs, and really everything around it kind of roll in together, right?
Yeah. So the common things that you'd run across, your gas and oil, your maintenance. Hey, John and T, you were just talking about you're dropping the engine. Maybe you got that fleet vehicle. It's not a $60,000 vehicle. It's a $200,000 fleet vehicle. And that engine, it's going to cost you $60,000, but it's cheaper than a brand new vehicle. So you can drop that engine in and start depreciating that, or if it's a smaller price, expensive. Tires, registration, license, interest, if you got a loan, insurance, and parking fees, tolls. If it goes into running the vehicle, keep it going. Hey, my car freshener, right? Updated mats on the vehicle. Those are all expensive.
Because we know you like, we'll say cotton candy flavored car fresheners and, pink and purple and glittery floor mats. So you have to have those in your vehicle.
It's weird you bring it. I got a 5-year-old daughter, and pretty much everything I own at this point is got some pink and glitter on it all over.
Yeah. Hey, I know how it is, man. In the most random places, sometimes you're going to take a pair of shorts or pants out of the dryer, and you're like, that ain't mine? How did that get in my pocket?
Yeah,
It's like,
it just
what is
literally
this?
blew up in the dryer, and you have no idea where it came from. Yeah.
And then if you look at them and be like, come on, you're 3 years old. You don't know this? Of course you don't. You're 3 years old. So here's actually another question then too, maybe. As bad as it is, I should know the answer to this one, but I don't, right? So say you take mileage instead of standard on a vehicle. Can you still write off fuel costs though too? Or does that standard mileage kind of equate for fuel and not maintenance and repairs, but
But that's actually
deduction.
a great question. I hear this constantly.
Good. I'm glad it's a good one and not a dumb one, because I felt kind of dumb asking it.
Oh, definitely not, Johnny C. Now, so if you're doing standard mileage, inside of that for 2024, the 67 cents per mile includes the cost of your gas, your insurance, the cost of the vehicle itself. They've kind of put it all into this one number. And the idea is if you drive a vehicle per mile, this is your cost of running it. Again, like I said before, a very cheap vehicle, yeah, this not only is probably more than your cost per mile, or equal to, but probably more. A more expensive vehicle, your cost of driving it is probably more than that 67 cents a mile, which is, gosh, man, I'm a little old, man. I remember when gas was under $1 a gallon.
Man, I remember leasing a fully loaded Dodge Ram back in the day for it was $99 a month, or it was $2,450 prepay for 2 years lease. Now it's like,
we
nope.
just gotta get back in my day. We bought a house for $5,000.
Right. But interest rates, they were at 16.5%. So Shawn, thank you so much, by the way, for explaining that. Cause I hear that so often that it's almost now I just kind of tune out, right? Especially going to, in the marketing world here. I remember going to tons of conferences and just hearing people's way of describing this. It's like, get out of here. So really, if you're smart and you, I shouldn't say don't care what people think you drive, but the whole beater with a heater mentality we used to say up here in Michigan. It's like, go get the cheapest car possible that gets you from A to B, hopefully, or at least almost all the way to B, has a heater in it, and then take the mileage, and you're actually making some. Like you're way better off.
You would actually get, you might not get more than what you can put into it, but it's real possible for you to get a much higher percentage back. If you want to round it out, now this isn't all in 1 year because they limit how much depreciation is in any given year. Even if you use bonus 179, normal maker's depreciation, with a little taxi on you there, I'm sorry. But you got a vehicle for $100,000, your tax savings and thus money back in your pocket indirectly is going to be, depending on your income, is usually going to fall somewhere in that 30% range. So even though you bought a vehicle for $100,000, your out-of-pocket cost is still going to be $70,000.
Makes sense. And let's actually talk about something too. And I know we've discussed this very, very briefly on a few podcasts, previous ones. There's been some content we've put out there around this. So let's talk about the 6,000 pound rule. So this is a fun one to me, right? Because sometimes you look at all these vehicles on the road and you go like, listen, man, you do not need a Suburban, or you do not need a fully loaded, full-size diesel pickup truck for what you do. But there's a lot of tax benefits to that, right? Including, I think, the most interesting example of this. I could not remember for the life of me if it was Land Rover or it might have been Mercedes with the G-Wagon. I don't remember which one it was, but they had advertised. It was either in Business Insider, Forbes, or somewhere, but it was a full-page ad. I do remember that, and it specifically talked about the vehicle gross vehicle weight being over 6,000 pounds, and how this is perfect for business owners. So to me, I mean, this was years back. It kind of blew my mind a little bit. I'm like, why in the world is this here? And really didn't talk a whole lot about price. which I think was pretty smart, from those marketing and advertising folks. But let's talk about that. Why in the world does a vehicle that weighs 6,000 pounds or more, why is that different from driving around, the explosive Pintos back in the day? I don't even know how much those weighed, but they weren't much. And if any, most people know what a Pinto is. But
they might have been a lot because it was all steel back then. But
true.
If you're talking a 6,000 pound vehicle or more, right? It's really 6,000 to 14,000, which is pretty much any vehicle outside of very large construction specific vehicles. Once you're over that 6,000 gross vehicle weight rating, now that expands out how much depreciation you can take in the year. They really, really limit you to a sub $6,000 vehicle is going to be limited to like 12,400 in depreciation. That's it. There's nothing more. If you have a vehicle more than 6,000 pounds, you can now take bonus 179 depreciation that can eat up most of the vehicle's costs. You're still limited in total depreciation for any given year, but it's much higher.
And then, so that's 6,000, right? So that's back to the example, right? Like, you look at some people and you're like, why do you need that? But either they really like large vehicles, they might have a lot of employees, equipment they're hauling around, or they are knowledgeable when it comes to this. Because there's no limitation saying it has to be a certain type of business, right? It's just general.
Yeah. And you pointed out a couple of big vehicles, right? This isn't the weight of the vehicle. It's a little bit different. So it's a gross vehicle weight rating. So this is kind of a special, like, maximum rating that this vehicle could get in holding weight. And so you might be looking at a smaller vehicle, like a Mercedes vehicle that it's actually luxury. They call it luxury vehicle limitations. You would think of Mercedes as a luxury vehicle, right? A bunch of their vehicles, just barely, like 6,100, 6,150, are right above that gross vehicle weight rating. Even though you're looking at it going, that's a relatively small vehicle. Its actual weight is 4,000 pounds or something, because they got to keep the mileage per gallon low. But they get that GVR up above the 6,000 so you can depreciate it. And of course, then the marketers go to play and they start bragging about it.
We're really good at twisting words, right?
Focusing on the benefits.
Exactly, of course. If any marketers out there who twisted for the negative, they're probably not they might be in politics. We're gonna leave that alone. But anywho, but yeah, I found that very interesting, right? So, and really, Shawn, like, what might be the reason again that they really did that? Like, is it more like they offer that 6,000 pounds? Is it to entice, one purchase or another?
I think the answer is it's somewhere in a holistic cause for, and there's never holistic with Congress, a cause of allowing for real business vehicles to get the full deduction, but also just Congress being Congress, and whatever side you're on, you can probably agree that it doesn't make a lot of sense. It is definitely a driver, though, of why vehicles are heavier, because fleet vehicles, if you go and get an F-150 and compare it to an F-150 in the 90s or the 80s, 70s, they were a lot smaller than they are today. And part of that is because of this taxes.
Makes sense. So and anybody too, if you have any specific questions too for our listeners on the 6,000 pound rule or any of this, as always, reach out to us. Obviously, there's Defeating Taxes, the private Facebook group. Ping in there. We got a lot of information. But Shawn, before I let you go here, so let's talk about one more thing that I know for a fact people have had this question because we've been asked this question. And it's really buy versus lease too. So maybe, what would be the benefits with each? Obviously, I think everybody knows what a buy is and what a lease is, so we don't need to explain what that is necessarily, but maybe give us a couple examples where one may work better than the other. maybe some things to watch out for where you could think you're getting a better deal, but you're losing on a huge tax benefit. Kind of walk us through your perspective of that, being a tax pro.
Well, being a tax guy and kind of conservative on spending cash, I tend to avoid leasing, but there are various reasons, whether it's cash flow, maybe you don't necessarily know if you need this type of vehicle, you don't want to take ownership, where lease does make sense. And heck, sometimes you just get a great deal on leasing. It happens. From a tax perspective, it does change your options. With purchasing the vehicle, you get the depending on how much you use it for, the better of mileage or actual costs. And that includes all of the costs of running it. But for lease, you're more limited to, you don't get that depreciation, right? You don't own that vehicle. So all you can write off is the monthly payment that you have plus the cost of operating. So if you have a $500 a month lease, then you're looking at a $6,000 a year lease cost, plus your mileage, insurance, and all the other things. Or you can do that mileage. Same thing. It's a 67 cents per mile.
It really, some of it may boil down to simply, does somebody like getting a new vehicle every 2 years and not having to worry about, for however long?
Yeah. For sure. Like I drive mine until they're rust bucketed out. But some might like them, brand new shiny vehicle every year. So that's that. From that perspective, I try to, like any vehicle, they come to me, hey, should I buy a vehicle? From a tax perspective, it might make sense. You might get a benefit from it, but I'd never suggest buying a vehicle just for tax purposes. It's got to make sense for you economically and from a cash flow perspective. So if you're looking to buy that $100,000 truck, but you don't need a truck and you don't have the cash flow for the truck, the tax savings isn't going to outweigh the cost.
And the car salesmen out there are hating us for saying this because they were hoping on their Christmas bonus. They get everybody, the week before the end of the year that's in there trying to buy vehicles. And I'm sure, so here's another dumb question I just thought about this too. So, for example, right? So a lot of my friends are in the construction space. So they all went out and bought they buy new trucks all the time for some reason. Yeah. Who knows? And you're right. Some of them are, darn near 150,000. So some of them went and they bought vehicles. So we'll say during COVID time, right? They're buying these vehicles, but some of them waited almost a year and a half to get it. So I imagine it's at point of registration that you could start any deductions on any of that, right? It can't be like, I put down a 50% cash deposit or I paid for it up front. I don't know anybody pays for one up front if you order it. But would it have to be at point of delivery?
Yeah, it would be point of delivery or registration isn't quite it. You could own a vehicle for 5 years and then place it in service and then start depreciating the vehicle. It's really the point of when it's actually available for business use. So whether you're waiting a year and a half for that vehicle to show up so then you can use it for business, or you've been sitting in your personal use for years and now all of a sudden you're using it for business, same thing. It's the date that it becomes available for business use is the magic day and year, thus, that depreciation starts, and you can start taking those deductions.
Makes sense. I'm scraping the barrel for the most random questions I can think of to ask you. So,
I kind of tried another one. Maybe you didn't realize it, thought of it, like that end of year purchase, right? You're going to buy a vehicle, it's coming in at the 31st, last couple days of the year. That, from a regular, normal, 5-year depreciation, which is that maker's kind of as slow as you can make it depreciation, that's going to be really low, right? But the accelerated depreciation, like 179 or bonus, those still apply just as if you had bought it on January 1st.
Makes sense. It's all.
So you can get it, if you're really trying to time things out, you might get a tax benefit and even a cash refund if you file your return early enough before your first payments are coming in for that brand new vehicle you got on December 31st.
And not to even get into EVs, because I know me and Chris had a discussion on this a couple months back But I know, like leasing, for example, with that, just kind of recap what we spoke about a while ago. I know with EVs, right? So say you lease an electric vehicle, you're really opting out of being able to take any of the personal credits, deductions, whatever they're offering for EVs, because the vehicle is really not yours. It's the dealership. So the manufacturer, I believe, is the ones that's taken those rebates, if you were the federal tax credits or anything through that. But obviously, if you purchase it, that's a different deal. So I think they weigh that into the lease prices usually, and it's outlined in all their marketing and advertising. But there's always credits around it too. So I think there's a used vehicle one.
Yeah. So that's pretty much you're pretty much nailed it. If you're leasing an electric vehicle, there's that up to $7,500 energy credit, tax credit for an EV vehicle. It goes to the owner of the vehicle. So if you're leasing the vehicle, then you're leasing it from someone else. Could be the dealer, could be Tesla directly. Either way, whoever owns that vehicle it's being leased from gets that credit. I have seen quite often where that credit is then basically applied towards the cost of the lease. So you still get it indirectly, but you don't get to put it on your tax return.
If anything, I'm sure they kind of take it into account when they come up with the depreciated value at the end of the lease, because we all know, we'll leave EVs out of it a little bit. It's a whole other discussion. I think either side of the fence, somebody, especially being in Detroit, right? So up here, people, you either love them or you hate them. There's very few people that are kind of in the middle. So we don't want to piss off 50% of our audience.
Yeah. The only thing I would want to add on the EVs, just to watch out, there's a sometimes overlooked unique thing about the EVs and that tax credit. If you were to buy a EV, and we'll use that, what were you saying, a $60,000 truck? If you were to buy an EV for $60,000 and then get that $7,500 credit, you can depreciate the full $60,000. You have to take the cost of your vehicle, $60,000, less the credit of $7,500, if that's what you get.
Mm-hmm.
So then your depreciation that you can take is $52,500 over the life of that vehicle's depreciation.
That's a great point. Great point.
That one's tricky. Even when I'm working with my team who works just taxes year round, they'll miss that. It's an easily overlooked difference for EVs.
I'm sure it's buried somewhere in the IRS publication that is about a mile thick, and you'd have to kill about 1,500 trees just to print that thing. So yeah, I mean, of course, you guys know every single page of that, though, right? Well,
of course.
How dare you miss anything?
It's why I'm reading material every night to go to bed.
Yeah, makes sense. But speaking of going to bed, of course, and the pink and purple floor mats, of course,
yes,
like a pillow. But yeah, speaking of going to bed, hopefully this topic didn't put anybody to sleep. Actually, I'm sure it didn't, because if it did, you probably just turned it off. But I'm glad we touched on this again, kind of as I alluded to at the beginning. There's a lot of confusion around this, and I wouldn't necessarily put it in the bucket of ignorance in a bad sense. It's just, I think it's sometimes when people think of, right, going into business for themselves, the whole entrepreneurship is all glitz and glamour, pink and purple floor mats, and glitter. It's not. So not everything is free. There are some complications when it comes to deductions and write-offs and all this stuff, and what expenses qualify for what. And this I would say is probably, in my opinion, from what I see, again, one of the most probably misused, unintentionally misunderstood ones from the taxpayer side. So thanks for diving into it, Shawn. I know I appreciate it. And hopefully our listeners do too. So we'll have to have you back on here. Maybe we'll do a Car and Truck 2.0 eventually.
Yeah, I'm sure there'll be some follow-ups. Yeah, they did make, like all tax laws, they tried to make them as clear as mud. And this one just has its own unique things, and it's not a common question or concern within the clients I've worked with over the years. And of course, when someone finds out that I do taxes for a living, hey, dinner, well, I got a tax question about my vehicle. Yeah, of course.
Always. But Awesome, buddy. Well, I appreciate you joining us back up here again on the podcast. I know you listened to it, which is always great. And I should have quizzed you on previous episodes to see which ones you actually did listen to. But, I won't harass you too bad.
Thank goodness.
I can't even remember all the ones we did. So
I got the memory. I have the memory of a field mouse, man. I don't remember what happened yesterday.
But the tax pub. That's the important part. We don't care about what you did yesterday.
Yeah.
Nobody else cares about you. Shawn, well, thank you so much, my man. We appreciate it as always. And again, as I mentioned a little bit earlier on too, any questions on this topic, please feel free to reach out to us here at Teaching Tax Flow. You can shoot us an email at hello@teachingtaxflow.com. Go on our Facebook page. That Defeating Taxes is that private Facebook group growing like wildfire. And literally we make it as easy as possible, unlike Congress and the IRS do for taxpayers. Go to defeatingtaxes.com and sends it straight to that Facebook page. So I don't have to give you the long URL, tell you to click here, click there, spin around twice, tapping your forehead, and then you're in. It's that easy. There's no excuse. That's your private invite. So, as always, we will see everybody back here on the podcast next week. Different topic, roughly the same time. See you soon.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.